Should you convert your pre-tax retirement or traditional retirement accounts to Roth IRA now? This is a common question I get from my clients, and I want to talk about this because since we're in the worst bear market in the first half of the year since 1970, you might be able to save some taxes by converting your traditional accounts to Roth accounts. But let's pause for a second and remember that this conversion strategy is not for everyone. Every time you make a Roth conversion, you have to pay income taxes for the year in which you convert. So if you make a Roth conversion in the year 2022, you'll pay the income tax of the conversion by April 2023. So how do you know if this is the right time to make the conversion? And does that dad joke have anything to do with this video? No. If you're brand new to my channel, my name is Sai and welcome. So in this video, I'm going to talk about our Roth IRA conversion strategy and if the bear market is the right time for you to make the conversion now. And I'm also going to go over the pros and cons of doing a Roth IRA conversion. If you're approaching your retirement age and you're not sure if your income will be higher or lower, is now the right time to convert your money to a Roth IRA. Please keep in mind that this is not any specific investment or tax advice. Every one of you has a unique financial situation, so please get with a professional before you make a decision that could impact your wealth. Make sure to watch all the way through this entire video and get ready to take notes because this is going to be one big juicy video. Also, don't forget to check out my Grammarly affiliate link in the description below. Let's first talk about the pros and cons of converting your pre-tax or traditional money to a Roth IRA. Before you make the conversion, you need to have a clear understanding of the Roth IRA conversion rules, or you'll end up paying a lot of taxes and also a 10% early withdrawal penalty unless you qualify for certain exceptions. You need to have a full understanding of the following four key terms: contribution, conversion, earnings, and rollover. A contribution to your Roth IRA is what you directly contribute or transfer from your bank checking account to your Roth IRA. And a conversion is when you decide to pay taxes now on what you have in your traditional IRA or other pre-tax retirement accounts, and then you convert that money you pay taxes on over to your Roth IRA. So anytime you do a conversion, you'll have to pay taxes on the total conversion. A rollover is when you directly move money from Roth 401k, Roth TSP, or other Roth accounts directly transferred to your Roth IRA, and you won't have to pay any taxes on the rollover because you already paid them. Earnings are the interest you make from contributions, conversions, or rollovers from investing inside your Roth IRA. And the pros of converting your pre-tax money to a Roth IRA are the following. The money you have in your Roth IRA will grow tax-free. And when you turn 59 and a half, you can withdraw your contributions and earnings tax-free. You can also withdraw your conversions tax-free 5 years after you make the conversion, regardless of your age. For example, if you convert $10,000 anytime between January 1st and December 31st, the 5-year clock starts on January 1st, regardless of the date you make the conversion. So you will be eligible to withdraw that conversion tax-free and penalty-free starting on January 1st, 2027. If you make the conversion anytime in 2022, you don't have to wait until you turn 59 and a half to make distributions from your conversions. And when you convert to a Roth IRA, you don't need to worry about future tax rates. No one knows for sure what will happen in the future, but if you believe Congress will raise our taxes in the future, then the Roth IRA could be the tax safe haven for your retirement portfolio. And if you're collecting pensions like military or Social Security, having a Roth IRA could significantly reduce your income tax rate depending on your total income. So if you decide to convert your money now, you're paying the conversion taxes in your current tax bracket. If you believe your retirement income will be higher than what you make now, then having a Roth IRA could be extremely beneficial. There are also no required minimum distributions or RMD with Roth IRAs during your lifetime. And with a traditional IRA, you have to start taking distributions at age 72 because your beloved government wants a piece of that retirement pie so they can get their fair share from your taxes. It's also easier to pass your Roth IRA to your spouse if you pass away. And the 5-year rules applies to the spousal transfer, and your spouse could inherit your Roth IRA like it's your own. And I'll probably make a future video about the inherited IRA, so be sure to subscribe to my channel for more content. Now, the con of converting your pre-tax money to your Roth IRA are the following. If you recently opened a Roth IRA, regardless of your age, you have to wait at least 5 years after you open a Roth IRA to make qualified distributions. And that means withdrawing your earnings tax-free and penalty-free. You can withdraw your contributions at any time because that's the money you already pay taxes on, and you don't owe the government anything. But you still have to wait 5 years, even if you're 59 and a half, to make tax-free and penalty-free distributions on your earnings. There's also a separate rule on the conversions you make if you're under 59 and a half. So for example, if you're 57 years old and you make the conversion, you will have to wait until you're 62 to make qualified distributions. If you don't have a lot of money in your IRA and you need it to supplement your retirement income, then the conversion might not be the right choice for you. And this also applies if your retirement income is going to be lower than your current income. And if you're in a high income household, your taxable income from your conversion to a Roth IRA could be a lot higher. For example, if you're single making $100,000 a year right now in gross income, your marginal tax rate would be at 22%. And if you make a $25,000 conversion to a Roth IRA, your marginal tax rate could be increased to 24% and pay an additional $6,000 in taxable income. Is it worth paying 24% in income tax to convert $25,000 to your Roth IRA? If you don't know the answer to that question, I encourage you to sign up for a free one-on-one 20-minute financial coaching session by visiting firesidechat.com/coaching. Now let's talk about why converting your money to a Roth IRA during a bear market could save you money on taxes. I'm going to give you a hypothetical scenario here on the drawing board, and I know you guys love the drawing board because my YouTube analytics says so. Let's say you're single and you have no income, and I know that's unlikely, but I want to simplify my explanation here, and you have $50,000 invested in a pre-taxed or traditional IRA, and you invest everything into an S&P 500 index fund. The S&P 500 is now down 20% year to date, and your portfolio dropped from $50,000 to $40,000. And if you move $40,000 in kind to a Roth IRA, you would save over $2,000 in taxes because your other $10,000 would have been in the 22% tax bracket. And then your $40,000 in the S&P 500 index fund will grow tax-free in your Roth IRA and eventually make it back to $50,000. And that $10,000 you gained would be tax-free. Let me give you another example, and I'll make it even more realistic. Let's say you're married and together you make $100,000 a year, and that puts you in the 12% tax bracket. Let's say your portfolio is dropped from, again, $50,000 to $40,000 in a traditional IRA, and you make the Roth IRA conversion of $40,000. Then you're saving about $2,200 in income taxes for the year. And again, these are very generic examples, and your financial situation could be entirely different. By the way, you can get our free FIRE resources by visiting firesidechat.com/contact. You can also check out the Fireside Chat shop, and I have all of my stuff on my bookshelf at firesidechat.com/shopping. What my wife and I plan on doing is the following. We plan to retire at 45, and we have a 5-year conversion strategy between the ages of 45 and 50. We won't be able to withdraw from our first Roth IRA conversion at age 45 until we turn 50 years old. We're going to convert our pre-tax retirement accounts every year so we can make tax-free withdrawals every year starting at age 50. So we need to keep our taxable income less than $80,000 a year so we can qualify for the 0% long-term capital gains tax rate, so we can live on dividends and capital gains during our early retirement. And I have a full video about our dividend income strategy, and I will put that video in the description below. But let me give you the breakdown of our Roth IRA conversion strategy. So when we turn 45 in the year 2031, we're going to have at least $1 million invested in our dividend stock portfolio, generating $40,000 a year in dividend income. And we're probably going to have either cash or stocks that can supplement our additional income. Now, let's go to the earned income. And earned income is defined as wages, salaries, tips, and other taxable employee compensation. This is completely separate from the capital gains or dividends. So let's say we make $40,000 a year from YouTube, and that would be considered earned income from self-employment. Now, let's go to our traditional retirement accounts. We're going to have about $500,000 total in our traditional TSP from the employer contributions, personal contributions, and traditional IRA. So what we would do first is to roll over our traditional TSP to a traditional IRA. Keep in mind that a rollover does not trigger a taxable event. And once the money is in the traditional IRA, which takes about a month or so, I'm gonna keep most of that money invested in the traditional IRA. Second, we're gonna move $35,000 or $40,000 a year from traditional IRA to Roth IRA, and that becomes a taxable event, right? So between my income at $40,000 a year and the Roth conversion at $40,000 a year, and that's a total of $80,000 a year in taxable income. And this is not counting any tax write-offs I'll have with my business. So if the income tax rate is still the same in the year 2031, then we will be paying around $6,000 in income tax, or an 11.24% in effective tax rate. That's incredibly cheaper than how much we pay now when we're employed at 24 or 32%, right? But the key thing here is we need to have other sources of income like our taxable brokerage accounts and cash to cover our expenses during the first 5 years. On top of all this, we could contribute more to our IRAs because we will still have our earned income, and we could reduce our taxable income if we contributed to our traditional IRA and then do the conversions again every year. Do you see how the cycle works now? So every year from 2031 to 2035, we'll convert at least $40,000 a year to our Roth IRA. And starting in 2036, we'll be eligible to withdraw $40,000 from that conversion tax-free and penalty-free. And we'll continue the conversion until we completely deplete our traditional IRA, or when we turn 59.5. By the time we turn 62, we should have at least $4 million in our tax-free Roth IRA, military pension, federal employee pension, and my wife's state pension. And we'll also continue to withdraw $40,000 a year or more in dividend income from our taxable brokerage account. And just keep in mind that your long-term capital gains tax rate is 0% if your taxable earned income is under $41,000 a year as a single filer, or $83,000 a year if you're married filing taxes jointly. And I expect that income threshold to increase a lot more by the time we retire early. And by age 60, we shouldn't be making any more conversions to our Roth IRA. The only taxes we would have to pay is our pensions like Social Security, military, FERS, and PERS in our 60s. If you got something out of this video, please hit the like button and share it with your friends and families. And if you want to know more about how to invest for your early retirement, be sure to check out these 2 videos. So with that said, I appreciate you watching my video. Don't forget to subscribe, and I hope to see you in the next video. Have a good one.